Today, my guest is a returning guest, Daniel Ameduri. He's the author and founder of the newsletter and the YouTube channel, Future Money Trends. And also, he's got a book most recently. It's called Don't Save for Retirement. And we're going to talk with Daniel a little bit about strategies that worked for one generation and maybe wrong for the next. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. You can like, share, or subscribe, and you can also leave a comment, and we'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. That's Commercial Real Estate Pro Network. With that, I want to welcome my guest, Daniel. Welcome back to CREPN Radio.
Well, thank you so much for having me on the show.
Well, I'm delighted to have you back, and I'm looking forward to our conversation today. And before we get started, if you could just take a minute and share with the audience a little bit about your background.
Yeah, I mean, it's the background is in the book, Don't Save for Retirement. So I'd highly recommend that everybody check that out. And it starts off with me and my wife at a bankruptcy attorney's office in 2008. And today we are financially free and traveling the world with our children. But like many people, I went through all those other cycles. I had a lot of credit card debt. I had housing mortgages. I had a lot of foreclosures in the '08 crisis. And I just kind of stumbled my way through it and eventually came across all the right people. It's such a small world, building wealth and investing in real estate. And I've been doing this as a hobby for many, many years. And then I started a website, and that's pretty much my labor of love that I do. And it makes a great living as well now. But I did it for free for years. So I'm very lucky to be able to do my hobby, which is anything and everything personal finance.
No, I love it. And as I recall, your Future Money Trends, you were one of the first YouTube, the first to get paid doing YouTube, or it was kind of like you were a pioneer, if I remember right.
I was one of probably only two people talking about the economy in 2008 on YouTube, and made some very successful predictions. It's funny, I actually thought the predictions would happen earlier, so I padded them. Well, they ended up happening like dead on by padding them, which was the collapse of Lehman Brothers and the Dow Jones. And Google had taken it over and eventually contacted me and said, hey, we're starting a new thing called YouTube Partnership. And I ended up getting paid by YouTube. So that was really cool because I was literally doing these videos every week for free. And then all of a sudden I'm doing the same exact thing I was doing, but I was making about $2,500 a month from Google, which was awesome at the time.
No, that's great. That's great. I love hearing that. So let's talk a little bit about your book. The title is definitely an intention getting one. Don't Save for Retirement. It's a little different than look both ways before crossing the street. Can you expand a little bit? I mean, on just the concept, Don't Save for Retirement.
The book could have been called Don't Save for Conventional Retirement, but I think the conventional would have been too much in the title. So we put Don't Save for Retirement, and specifically to the younger generation, I think that saving for conventional retirement it's an experiment that has pretty much failed for most of the baby boomers. Even the ones that were high income earners who lived like peasants, now they've conditioned themselves to save, 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 save. And if you speak to many of them, or if you read some of the data from Fidelity, they're living in the scarcity mentality. They're having trouble even spending the money because you can't save for 30 or 40 years and then cut your active income out of your life and then all of a sudden draw from this chunk of money. It'll make you sick to your stomach when you think about it. And for young people today who would do that to themselves after we've already seen that it's not working, I don't understand why they would do it. So there's another way. There's a way that's been proven for thousands and thousands of years, and it's what the rich do. And so instead of being speculative with your money and putting it in a 401k and hoping it goes up, and by the way, the most speculative part of the 401k isn't the stocks in it. It's that you have no idea what rate you're going to pay on withdrawal. Nobody would take a loan from a bank and not know what your interest rate is. But that's what we do every day when we take that deduction on the 401k, and we have no idea what the tax rate's going to be when we withdraw that money. All we do know right now is we have to pay a 10% penalty to have access to our money, which is kind of frustrating. So the middle class is very focused on speculation and appreciation, and the rich are focused on preservation and income. And if we simply adopt that lifestyle combined with sustainability, a sustainable lifestyle, you can be financially free and independent within 5 to 10 years.
I tell you, it's something that's definitely, I guess, kind of crystallized in my focus, and I know one of the things I've recognized is as both a getting older myself and aging parents, and also clients as an insurance broker. I have clients that they get into business, they grow the business, then they get out of business, and I think that the thought process for me that's crystallized is that recognition of that people work really hard to grow something, but very rarely have a crystal clear idea how they're going to get out or how they're going to get their money, out, and whether or not that's fully understood. And like you just said, I think that's the first time I've ever heard that, is that notion of not understanding the cost to get your money kind of thing, as opposed to, you've been working so hard to put this in, put this in, put this in, put this in, put this in. So that's awesome.
By the way, Darren, the tax rates, if you look at the federal income tax, it was this low in 1931 and for a brief blip in the 1980s. But if you kind of look at the chart, we're basically paying the lowest taxes right now since 1931. And then you got to ask yourself, with $22 trillion in debt and trillion-dollar deficits, do you think taxes are going up or down? And I think it's pretty obvious taxes are going to go up eventually. And so you're pretty much guaranteed to pay a higher tax than you are today.
Wait, you're saying the trickle down's not going to work? What are you saying?
I'm saying it doesn't matter what happened, but it has been a long time coming. The United States is definitely on a trajectory of being in an unsustainable situation.
I gotcha. So let's talk about some of the aspects of the lifestyle or the different way of thinking. What do you see as some of the traditional ways of thinking that have gotten people to this point?
I think the normalcy bias of the acceptance of so much debt in one's life, financing a car for 5 to 7, 8 years. If you make $50,000 a year, buying a $50,000 car, it makes no sense, but it's actually quite normal in our world. It's perceived as normal, but it shouldn't be. Same thing for a house. I understand the appeal of getting a 3-decade loan, but why does it have to be 10 times your annual income? Why are people buying things 7 times their annual income? That's unsustainable. It puts them in a situation where there's no room for air, there's no room for living. And like most things in life, a lot of times people are buying things to impress other people, when the reality is, after the first day of introducing your new car to your friends, no one cares, and you're stuck with a bill. I remember when I became financially independent, I was still driving a 2003 Nissan Altima, and it was almost like a badge of honor. Now, at the time, I was in save and sacrifice mode, and in the beginning. And I'm not going to lie to people. Look, the book will explain if you're going to do this, if you really want to become financially independent fast, because you could do it slow. I'm saying if you want to do it fast, you're going to have some upfront sacrifices for the first year to 2 years. But as you sacrifice and save, and then have that mind shift of living a sustainable life, combined with, instead of buying things for speculation, you start buying things for income, those good decisions start to compound on themselves. And all of a sudden, your expenses are way down, and you have multiple streams of income. And instead of just one source from yourself, or 2 from yourself and a spouse, you might have 6 or 7 sources of income coming in. And in the beginning, it might be small. It might be only $50 a month, but you'll use that to pay a water bill off, or you'll use that to buy more income. But I want people to understand that this is not income that you just save and save and save for 30 years and maybe it works out for you. This is income that is usable, is spendable income, and can also grow. But the main focus is having that sustainable lifestyle combined with multiple streams of income, as much income as you can bring into your life.
The streams of income, what have you found to be I guess I don't say the norm, but are there some go-to points for, buying a stream of income that you find people go to?
Conventional thought is dividend-paying stocks and bonds and fixed things from banks. But the reality is you're far better off being involved in the real estate market. And if you look at other countries who've gone through crisis, The real estate investors always come out okay on the other side. It's a physical property. People, no matter what happens to the economy, people need a place to live. I tend to have a heavy bias towards either real estate note investing, physical real estate, rental properties, commercial real estate. There's a lot of opportunities in commercial real estate because there's more seller finance deals than there are in, let's say, if you wanted to buy a single family home, get credit or something. So I think there's a lot of opportunities to create passive income in real estate. And if you're like, hey, I don't want nothing to do with that kind of stuff, that's fine too. There's tons of crowdfunding type real estate vehicles like Fundrise and Peer Street. And then there's also old money private REITs that have been around for 70, 80 years. And I love those because they've been around through multiple crashes, including the 2008 crash. And these companies regularly are paying out 8 to 10, even 12% yields. And people are like, well, what do you own? What do you own? You own slivers of JW Marriott properties, and you own fractional shares of brand new Walgreens and beautiful golf courses. So a lot of times, instead of buying a physical, individual, single-family home where you have a lot of risk, you can own some. You can actually upgrade your income by partnering with some of these groups who invest in very quality projects and assets.
So let me ask you the comparison between the an income stream as opposed to the traditional 401k mentality of put your money in the stock market. I say stock market, your 401k.
Yeah.
Do you think there's more of a mentality shift? Is it taking control? Is it just doing what's comfortable and presented to you? Is it an option? What do you see as kind of the hurdle for people to get from the traditional way to more of an income stream?
The biggest hurdle is that they've all been conditioned that this is the way to go. And certainly the intentions were probably great for retirement. And that's a great incentive to bring the best employees and give them a great retirement plan. But this is relatively new. You can trace the pension system back to the Romans, but then it skips 800 years and jumps to Germany in the late 1800s. And the 401k, the IRA, all this stuff, most people don't realize it. This has been around. It was passed in the late 70s. It's been around essentially since the 80s. And a lot of these things have become great vehicles for Wall Street to make money. The fees, the commissions, the vehicles, the ETFs, the explosion of mutual funds. There's more mutual funds than there are stocks. And so this has been a great time for Wall Street. And there's a book, I can't think of the guy's name, but the title is Where Are All the Clients' Yachts? And I think that's what people should look at. Where are all the clients' yachts? Wall Street, and if you look at hedge funds and Goldman Sachs, what they're buying or what some of the richest and wealthiest institutions are buying, it's much different from what their clients are buying. And certainly, anybody who's going to run a portfolio, you have to run it like a business, and businesses need cash flow. So it's just such a shame that most people just blindly throw the money at the 401k. 60 Minutes has done studies. All these hidden fees, sometimes they're taking up to a third of what you should have made. And they've got even worse ones now where you do these target things and they have even more fees. So everybody treats it like it's been a perfect world. Like Adam and Eve came out with the 401k plan, and the Dow Jones has been around for 1,000 years. And it's not. None of this is. You can't just tell everybody that it's going to compound at 12% for the rest of your life. That's ridiculous. And by the way, one last thing real quick. Nobody compounds average returns. They're constantly saying the average return is 10% or 12%. But let's be real. No one's compounding at an average return. The stock market goes up, you might buy high, then it's down. And look, if the stock doubles 100% one year and then goes down 50%, they'll tell you about the average return. But where are you? Right back to where you started.
Right. Now I've always wondered about that, how you can actually calculate the return, and it is, I mean, conceptually, saving for a future date, for whether it be a purchase or some sort of a to be financially free, the concept makes sense. But I think that what I hear you saying is where is the money going and how's the money work, whereas on a real estate, it seems like it's a little bit more clear, or there's a direct line of you can understand exactly the money goes in, there's a vehicle, whether it be the note you have to pay, the income that's coming in from the rent. I mean, it's a little more direct. Is that kind of what I'm hearing you
Yeah.
say?
And I'm not all in on real estate. I own a lot of stocks too. And
Mm-hmm.
my children, I teach them to buy stocks. They own Disney and Costco and Kimberly Clark, these great companies, great businesses that over deliver. And the reason they pay a dividend. So it's very important. I train my children like, hey, if you're going to invest in a business, they need to share in the profits. That's the entire purpose. That if you remember, there used to be a video back in World War II, and it's on YouTube, and it explains why people buy stocks, and it explains about that the companies are receiving capital to grow the business, and then they share profits with investors. But somewhere along this journey, companies stopped sharing the profits with investors, and everyone just became a speculator. If the only way for you to make money is for the next guy to pay more than you are speculating. So if you're going to buy a stock, but make sure they're sharing in the profits. That's the entire purpose of owning a business.
God, I love that because I think a lot of what happened up to the 2000s and that was more about stock split, stock split, stock split, and it was more of, like I said, just a speculative thing. And again, I'm not the biggest in the stock market or anything. I don't fully keep an eye on it like others do, and I'm sure you do. But just the whole notion of the price per earnings and stuff, and how that has blown way out of the of round of what was traditionally thought to be a model. I don't know if you can maybe speak to that even. Just is that am I speaking in relative terms, or is that?
No, but you're right. They throw that out on MarketWatch.com and CNBC about PE ratios or the Dow to gold theory, all these different things. Look, it's all fugazi. We have the game has changed. There's algorithms involved. There's more computer trading for half a penny than there are humans. So things have changed, and if we don't change with it and consider that all these changes have happened, we will end up losing money, and or we won't get any of it. We won't be able to retire. And I again, in the book, Don't Save for Retirement, which by the way I have for your listeners at futuremoneytrends.com/save. They can read the first chapter and the intro for free. And the book comes out on August 20th, but they can read that anytime right now. So, if people just keep following these metrics, look, we have no idea. The last 20 years is going to look totally different than the next 20 years. Think about it. Some of the biggest companies on the planet, Netflix, Instagram, Facebook, Uber, biggest companies, some of the biggest companies on the planet, they didn't exist 11 years ago. Some of them didn't even exist 10 years ago. So a lot of things are going to change. So I don't like using any of those metrics. In the end, how much am I going to invest and how much am I going to make every month or every year from the income?
No, that's another reminder, just of nothing lasts forever kind of thing, and kind of a drive home that speculation. If you're waiting for it, you're waiting for it, wait for it. It may never come, kind of thing. Based on you think about some of the companies that were, that were so big and dominant in my childhood that are no longer. But that's great. So you mentioned a little bit about your kids and working with them and getting them taught to invest in the market, but know that they're going to get a return, that the company is going to share in the profits. Are there any other kind of points that you recommend people talking with their kids about? I mean, I think that's kind of one of these things. You talk about this generational thing, and that, like, for the baby boomers, it may have worked, but the Gen Xers or the millennials, it's clearly not what they're looking for. Are there some points that you make, for young people, especially for kids? I mean, I'd say elementary, kids that haven't got started in the workforce yet.
So with my family, I have a 5-year-old, a 7-year-old, and a 9-year-old. We regularly talk about money. If we have a property we go to or an investment we look at it together. There's an escrow closing. They come in the office and sit down on the floor. They're just around it. Just like, if you want to teach your kid the construction trade, you bring them on the job site. You want to teach your kid to farm, you bring them on the job site. Well, I want them to know how to invest. It's very important to have this mindset of having a buying income, bringing income into your life. So Cambridge did a study that financial habits are actually developed by age 7. So
Wow.
absolutely, you mentioned elementary school kids as early as you can. We played Monopoly with the kids, the very simple one when they were young. Now they play the regular one. They pay the cash flow game by Robert Kiyosaki. Instead of playing Uno, there's a game you can buy called Net Worth, very similar to Uno, which kids love. However, on net worth, you're paying off debt, you're paying off credit. Um, so it's good to get the mindset into focusing on those type of things and understanding it. Because keep in mind, parents, they're not going to get any of this in school. They're going to get nothing. In fact, they might even get some bad habits taught to them. But so it's important for the parents to, go over with them. I love when my kids have to buy something, they pay for it at Target or something if they're buying a toy. They have to look at the receipt and explain to me what's going on. And, I'll help them, of course, the 5 or 7 year old, but they have to understand the value of money. And it's interesting. I was at the grocery store with my son the other day, and we bought just a handful of items, and it came out to $79. And he understood the value. He's like, Dad, I'm surprised. I thought that would be like $20. And it's kind of helping him understand, hey, when you save $100 from birthday parties, don't go blowing $50 on some toy. In fact, we make our kids save 50% of everything they make. And originally they were saving in checking accounts. And I was like, why aren't they buying assets that buy income? So we opened up a brokerage account for them, and now they buy, some very friendly stocks that they actually engage with, because it's a twofold lesson there. Let's just do an easy example for everybody. If you get your kids to buy Disney stock, not only are they understanding a little bit more about the stock market and business and fractional shares, because that stock does pay dividend, but they also understand, and it might even make them more interested when they hear about Marvel making $1 billion or something, or the parks, because they realize, hey, I'm making more money, and they'll really start to connect. But I even go like a step further when we interact with Disney on their cruise ships or their parks. I always talk to the kids. I'm like, what do you notice about Disney versus another theme park? Or Costco's another stock they own. I was like, what do you guys like going to Costco? They love going to Costco. Do you like going to any other grocery store on the planet? No. Who the hell cares about going to Vons or Safeway or any Kroger? You don't feel anything when you go to those grocery stores. But the Costco has an experience. And I always bring that up to them. I'm like, what is this business doing? And it's very important to teach the kids to over deliver, because outside of the investments, kids need to understand that you don't make money from working super hard or being super smart or working for this guy or that guy. You make money, the simple equation, you give value to other people. And if you give more value than they paid for, you'll make more money. So I'm very, very focused on teaching them that no matter what you do, whether have a job or a business, you always over deliver for people. And that will be your economic peace and security, over delivering for whoever you're working with.
No, I love that. I love the just the concept of money and getting them glued into it as soon as possible. I know my oldest just got his driver's license, and we've had the conversation about the gas pump, and they're always surprised at what it costs to put gas in the car, kind of thing. It's like, it's real money. So that's great. Hey, Daniel, if we could, I'd like to shift gears here
Sure.
for a little bit. As I mentioned before we started, I'm an insurance broker by day, and work with my clients to assess risk and determine what to do with the risk. And there's a couple of strategies we typically consider. And one is avoid the risk, two is minimize the risk, and then three is transfer the risk, which is what an insurance policy is. And recently I've started asking all of my guests to identify what they consider to be the biggest risk. And just to clarify, I'm not necessarily looking for an insurance-related answer, but if you could, if you, Daniel Ameduri, could say what you see as the biggest risk.
I think my personal biggest risk at this point, because of what I learned in the scars from '08, my biggest risk right now is simply myself. I have no debt. I'm a big believer in having no debt. I've surrounded myself with 21 sources of income. I have a great business, so I mean, I'm well capitalized. I'm not leveraged. So all the big risks that that blew me up the first time are out of my life. So I would say the biggest risk is just me Perhaps wanting to go on too many trips, too many traveling trips, not being focused, losing my focus, losing what got me here. And I'll give you a perfect example. I mean, I just spent 35 days in a trip that we went to Kenya, and then we came home for a week and then went to Japan for 3 weeks. So my biggest risk is just having too much fun in life at this point, because I've done the hard stuff. If everybody's not happy with that answer, I could say the biggest risk to all of us is probably the bond market. I mean, that could throw the real estate market into a tailspin. It could totally implode the stock market, could even affect the US currency. So my absolute real biggest risks are things I can't control. The biggest risk that I can control is me sleeping in.
Yeah, that's great. I recently have been reading Howard Marks, some of his books on, I think one of it's like the biggest, or the biggest thing, or I don't know, the one biggest thing, or something like that.
It's always the most important thing.
The most important thing. Yeah. And just just how it's everywhere. I mean, the risk, it's not limited to one thing. And what I think the theme that I keep hearing him come back to is people. It's none of it's, the market is not mechanical. I mean, you can set something on a path, but it's the interaction of people and how they react, and whether the emotions of the people of the market, and like I said, things that you can't control, that are really the things that are out there. So
it's so true, because think about when you buy like a smaller company. I've invested in a lot of these cannabis companies, and I hope they do well, and they should do well. But you know what? Sometimes I go to bed thinking, I'm like, man, the whole thing holding that company together is one guy, the founder and CEO, who's working 16 hours a day. I'm like, if something happens to that guy, he crosses the street, that company is going to zero. And it might not necessarily be as drastic for like your blue chip stocks, but there are some very, very good CEOs who are the driving force of their businesses, that if something happened to them, you can imagine the company might go into a tailspin or lose its focus, much like Apple did when they lost Jobs. Jobs, literally, when he came back the second time, he pretty much pulled the company from, I think they had like 1% of the market at that point. I mean, the company was going to die. And now it's, one of the most popular companies and probably the most popular brand on the planet.
Right. No, it is interesting, and you don't realize it. I think a lot of times as things are starting and going, but just how much of the identity and the momentum that a company has is tied up with the founder, or one or a couple people, kind of thing. And so that's interesting. Daniel, where can the listeners go if they would like to learn more and connect with you?
I would love for them to go to futuremoneytrends.com/save. They'll be able to subscribe to the free weekly wealth digest. You'll get letters about what the different experiences my wife and I went through as we were coming up, as well as exactly what we're investing in right now. And I like to bounce a lot of different cash flow ideas off of some experts. So we're trying to introduce new cash flow ideas, because I'm selfish. I want more. I want to learn more, and so I share it as soon as I get it with everybody. And you'll also be able to read the intro to the book as well as the first chapter. And there'll be a link there if you want to continue reading the book, and you can buy it on Amazon.
Got it. And I will put all that in the show notes, and I highly encourage any of the listeners to go check that out. I've read first chapter or so, and it's extremely well written, and it's a compelling story. And for anybody that's interested in, how to take control of your money, I highly encourage you checking out Daniel's stuff. So it's good stuff. Daniel, I want to say thanks for taking the time. I've enjoyed it, and as always, learned a lot, and hope we can do it again soon.
I really appreciate your time. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.